Are you looking to get life insurance? No doubt you have people in your life that you love and they depend on you to live. Any responsible person would ask themselves what would happen to their family if something were to happen to them. Would your spouse be able to pay the mortgage? Would your kids be able to pay for college? Would they be okay? Life insurance is a great way to protect those who are financially dependent on you. There are two different types of life insurance, term life and whole life. The difference between the two can be compared to renting or owning a house. Deciding which one to choose can depend on your needs. Term life insurance can be compared to renting a home. It only lasts for a specific amount of time or a term while you pay the premium. If the term ends without needing it, neither you nor your dependents will receive anything. However, if you pass away during the term, your beneficiaries will receive a death benefit in the form of a tax-free lump sum that can be used for funeral expenses, to pay off debts, or for living expenses that you would otherwise have been able to provide for your family. Whole life insurance can be compared to owning a home. Whole life will guarantee lifetime coverage and will pay a tax-free lump sum at the end of your life. It will accumulate a cash value inside of it over time that you can withdraw or loan to yourself for any reason. Many people will use the cash value to supplement retirement savings, to pay for their children's college, or they may even use it as an emergency fund. If there is still a cash value inside the policy at the time of your death, that amount will be passed on to your beneficiaries on top of your death. So let's look at the pros and cons of each type by looking at the Murphy family. Mr. and Miss Murphy know that if anything in life can go wrong, it will. And they want to make sure that their family is protected. They have 2 children that they want to provide college funding for. They have a $250,000 mortgage and other personal needs like car payments. Term life insurance would provide coverage for 5 to 30 years or until the age of 65. If they were to pass away, this would allow them to make sure their mortgage is covered, to pay off their children's college and provide for their children until they were adults. This type of life insurance is cheaper. While it is the simplest form of life insurance, there are downsides. One downside is their family will gain nothing if they do not need to use it, and they hope that they don't. It also does not accumulate a cash value like the whole life insurance offers. There is an option, however, to convert to whole life before the term is up for a higher premium. Whole life offers everything term life offers and more. It will cover the Murphy family for the rest of their lives and guarantee that their family will receive a tax-free death benefit when they die. Because it is guaranteed, whole life insurance is more expensive. However, a whole life insurance policy will grow a cash value, tax-free, and can be used by the owner of the policy. The premiums are also more flexible. One such way is that the cash value can be used to pay for the premiums. Another way is that you can pay more into the policy up to a certain limit so that it can grow more. The Murphys can use the cash value to pay for their children's college or to pay for their retirement expenses. Whichever type of life insurance the Murphys choose, their family will be protected from the financial pain that would inevitably come from an unexpected loss. The only way they would lose out is if they chose not to take any action.